Good afternoon, everybody. This is Andy Profit. I'm the SIG chair for the AAII Portland Income Special Interest Group, and this is our May 2022 meeting. Welcome, everybody. And I have a few warm-up slides here, and then we'll turn it over to Ray and to our discussion of the topics at hand. This is our usual disclaimer that we normally put up, which means that we are a group of people who get together on a regular basis, monthly basis, and discuss investing ideas. But please don't take this as investment advice. It's simply an exchange of information. And as I keep saying, this is a self-directed group. We hope to learn from each other about sustainable stream of income and growing our income faster than the rate of inflation. And of course, to preserve capital, and we generally hold for long periods of time. To be a better investor, I strongly recommend that you consider this group as a group that works best when you become an active participant. What I mean by that is we want you to encourage you to suggest speakers. We want you to propose income-oriented topics that you would like to see discussed. You share your knowledge, share your research, and share your favorite websites or tools that you like that you have found to make you a better investor. We're here to learn from each other, and I encourage you to step forward and do this. This is how this group works. And of course, as you might expect, the demographics of our group is primarily folks who are approaching retirement or within their retirement years, who are trying to enhance their investment income. This is our Google group. We have a private group that is under Google Groups, and you can share all your discussions there. It's just for our particular group, our SIG. You can express yourself there, and you can share ideas and get information from your fellow members. I strongly encourage you to use this group. Just a quick few words about the main chapter here in Portland. We are based here in Portland. Our president is a gentleman by the name of Todd Blickenstaff. He's our president. And Todd is working hard on trying to get some speakers for our next meeting. There will be announcements on that coming up in the next few weeks. This is a list of the this is a list of the presentations that are online. This particular is on our website, the Portland AAII website, and the videos are there for both the SIG and for the main chapter. So we encourage you to participate by going to that particular site and looking at those videos. We also maintain a YouTube channel, and that YouTube channel essentially has the same information. It's just on the YouTube channel. So if you click on AAII Portland chapter, you will go to this particular channel where you can see the same videos that are available on our website. And there's the all Portland chapters. Okay, so here's the agenda for today's meeting. I'm going to be turning it over to Ray, and then we'll talk about we'll have an open discussion following that. And rather than give you come back to the slides, here is our closing comments. You do this right now, and then I will turn it over to Ray, and we'll finish up with our discussion. So we always look for ideas and speakers. Please send them to me. There's my email address. And of course, you can always post them on the Google group that we have available. Again, it's for your pleasure and for your benefit. So our next meeting will be June the 5th. I hope to see you there. Now I will stop this particular section of the presentation and I will turn it over to our speakers. Ray.
And
it's okay. I'm starting recording. Okay, go ahead.
Oh, okay.
Yeah.
I'm still trying to make this thing larger. I don't know what the hell's going on here. Actually, I hate Zoom. Anyway, so we had 19 respondents, and the questions we were kind of asking ourselves are, what do people have? What are they interested in possibly looking to in the future, or getting out of, what's on their radar? So those are the two questions of what's income producing that you hold, as well as what's on your watch list, your radar, or whatever. And to get everybody kind of focused on the I'm still having tremendous problems with my Zoom here, so I don't know what anybody can see. What do you see right now? Do you see?
We see your Yahoo, my Yahoo, and you have your portfolio on the left and the my mail on the center. So forth.
It's like so confusing.
Yeah.
Because I can't see what you're seeing, and Zoom is fighting me right now. Okay. So what I intend for you to see is the email that was sent out. I don't know if I can't see what you're seeing, so I have no way to verify this. But it was just, I asked 4 little questions to kind of get everybody's mind going a little bit. What was the average number of holdings for an individual portfolio? What percentage of all individual holdings were held by at least 2 people? And can you guys see that right now or not?
All we see is your my Yahoo page.
Mm-hmm. God, I don't even know what that means. There we go. I see that now. Okay. I'm not going to be able to figure that out.
Stop sharing your screen and then select a different one.
I think I'll try that then.
Yeah.
So the thing is, whenever I do these, I have to relearn just the one thing of what I want to share is just what I am seeing on my screen, a mirroring of my screen. So can somebody direct me to which one of these? Is it called whiteboard?
No. You'll see, if you move your cursor, you'll see down at the bottom or at the top, a green screen, share screen.
I've got that. And then it brings up 6 choices. It brings up what appears to be all my open apps.
That brings up your desktop, and then you select one of those choices that you like. For example, you want to share your spreadsheet. Try that.
Yeah. So I'm gonna somehow forget everything that I've been doing with this, and pardon me and all that kind of crap.
Do you have a PowerPoint presentation or what?
No, what I've always used Zoom for is I use it to mirror exactly what I'm seeing on my screen, so I can toggle between all my various apps, because I don't think in one app. I've got stuff in 4 different locations. So right now I'll just share this, which is a cumbersome way of doing it. But so here are the 4 questions that I was kind of putting out to everybody, because you can see that now, right?
Yeah.
So I guess I might have to just every time I want to go between screens, I'll have to stop a screen and share a new screen, which I don't understand that. But anyway, so what's the average? Pardon me?
The other way you can do it, look for the word desktop under your screens that you're seeing and select that one.
Desktop under the screens that I'm seeing. So I'm going to stop that, share that. I don't see a word desktop. I'm sorry. We're not going to solve this right now. I know a workaround for whatever this is. So we'll just put that on hold for a minute. So I had intended to basically just kind of share these various questions to get us thinking about it. And we'll kind of speed through them because I've chewed up 6 minutes probably here going in circles. But Does anybody want to just throw out any numbers for what do you think the average number of holdings are for an individual portfolio for the 19 folks that submitted? Does anybody just throw out a number for the hell of it?
I'd say somewhere between 20 and 30.
Pretty good guess. It turned out to be 35. Yeah, 35. And the standard deviation, which is part of the interesting stuff, was the standard deviation was 38, meaning there was a huge range. We ranged from, I think, 9 at the low end up to 173, I think, at the high end. And then the next question there was, so you can see that's a huge range, and maybe people interpreted the question differently. It was maybe people thought all their positions. Some people just thought maybe the ones of most interest or significant holdings. So, you never know when you're collecting data if you're getting exactly what you think. The next question though is like, what percentage of all individual holdings were held by at least 2 people? And I was going to actually do a tiny little back pivot here for a second, in case something goes wrong technologically, because I'm actually up in the mountains right now at our cabin with about a 3% unreliable factor on the internet and the power. Tom's my backfill, and Tom's got read privileges on the main document that is the main one that I'll be speaking from today. So he can, if the gods suck away the electricity of their internet from my cabin here, then Tom can backfill. But the next question, of all the positions that people held, do you think we kind of clustered onto some real common ones? Everybody held the same ones, or did everybody basically hold unique stuff and just a little bit of overlap? So of all the holdings for those 19 portfolios, what percentage were held by at least 2 people? So non-unique positions. And just humor me, if you will. Somebody just shout out a number.
A third to a half.
A third is a pretty good guess. So a third, it turned out to be about 30%. And we'll look at the data a little more granularly here as soon as we get through these next 2. The next one was surprising to me, more surprising. How many stocks, ETFs, because it could be MLPs, closed-end funds, income-producing vehicles, were held by most of the respondents? So there were 19 people. So at least 10 of the 19 would constitute a majority. So out of all the positions out there that people held, how many of them do you think most people held? So, the Chevrons and Johnson and Johnsons and AT&Ts of the world and stuff. How many different positions like that were held by by a majority of the folks? What does anybody?
Wild guess is 14.
14. I mean, 14 people, 14 of the portfolios, you mean? Is that what you're saying? Wow.
What I was meaning was like, Chevron, all the various AbbVies and
well, given
position.
given that 30% of that individual holdings were held by at least 2 people 30% of the time, in order to get 50% of the people holding the same thing, it's got to be a lot less than 30%. So I would wager less than 10%.
Huh. All right. I would guess maybe 2/3. That would be off the top of my head, but I guess maybe my logic is not correct.
So the answer was 1 position.
What?
There's only 1 position that a majority of the respondents held.
What was it? Was it AT&T?
And that's question number 4. Question number 4. What was the most widely held stock, ETF, blah, blah, blah? So that's the question.
I'd say Johnson & Johnson. That's what I'll vote for.
I'll just jump to the chase. Andy wins a turkey prize.
Hey, Please, I do not accept autographs. Sorry.
So hopefully that was fun. Now I will stop the share here on this screen and go over to the main thing that we'll be talking from. So whoops, that's not the right one, you silly thing. Let's see. I opened the wrong one. I want this one. So we are right there. So here is, hopefully everybody sees now the main document of the big database I put together. You see it's called at the top there, Portland Income SIG Positions and Watch Lists. And everybody sees it, right? Everybody's onto it. And I've got 6 tabs here for how I compiled the data. And I built this all in Excel and then I copied and pasted it to Google because it's going to eventually be in a Google Drive. And because my computer's been malfunctioning lately and I knew I was going to be in the mountains and everything else. So I wanted to make sure there was a backup. Somebody could access this in case we had a power outage out here or something. But each column here is a submitted portfolio. And you see my cursor as it moves. Is that true?
Yeah. Yeah.
Okay.
Yeah.
So here's portfolio 1. The first person submit theirs, second, third, up to the 19th person. And then right below that was the count. So, 25, 59, 10, 175, 11, 9. So really wide variety of individual positions. And then I took all of that, cut and pasted all of these into one big column, basically, this column here, and sorted. And then there's probably an elegant way to do this, but I just brute forced it in Excel. Figured out which stocks. I set up, just a number crunching thing here to find the number of stocks held by 2 people. So here's individual stocks, 293 of them, 293 income producing vehicles that are held by a single individual, 61 that are held by 2 people, 15, 18, all the way up to Johnson & Johnson at 11/19 of us, 58%. And then curiously, there were no 10 out of 19s. So you can see here, 1, 2, 3, 4, 5, 6. So held by 7 people or more, there are only 6 positions, 7 out of 19. You drop down to 6 out of 19, you're below a third. So around a third of the portfolios, a third of the portfolios would have those stocks in common. And then I did a similar thing here with the watch list, people's watch lists. And as you can see from the watch list, there were a fair number of folks that didn't submit. They just submitted just their holdings. So the watch list is not nearly as populated, but I built an analogous little summary kind of engine here. And you find that of the 8 portfolios that were submitted not portfolios, but watch lists that were submitted, folks have 168 things on their radar. I'm not. It's 24, I guess. Yeah. I think I built this thing here this morning, actually, this little thing here, but the number of people that would have, the number of positions that would be of interest to 2 people is kind of in the order of a couple dozen, and then drops way down to 3 at 3 people. But then I put it all together here in a more succinct table with a name for the table to suggest kind of the main message of the 19 portfolios. Roughly 70% were unique positions. roughly 15% held by 2 folks or more, roughly 15% held by more than 2 folks. And that's, this is just a summary then of that data. And then another way to look at it over here is the here's the whole, the reason you tuned in. The only 6 positions held by more than 37% of the portfolios that were submitted: Johnson & Johnson, AbbVie, right, I believe, Verizon, Cisco, Chevron, and Pfizer. And then if you drop down, so that's already down to 37%. So the majority of the portfolios had Johnson & Johnson in it. Just under a majority had AbbVie and Verizon. Next most popular, Cisco and Chevron, then Pfizer, and then you start running into the math of large numbers or something like that, probably, where now you're going to have all kinds of combinations to get to 6. So I'm not going to get all these right. Amgen, ENB, I'm not sure on, Intel, Coke, Microsoft, that Realty, that's ETF, and AT&T. So there's AT&T. AT&T just misses out on the top 6, and comes in the group of 7. And then if you go down to, the group of folks at rank position 7, 6 out of 19. If you go down to 5 out of 19, which would start with rank position 15, you have these holdings here. And then as you move on to just 4 portfolios holding something, you've got 18 more. And as you go down to 3 portfolios, whoops, that was silly. Dragged my fat finger across it. As you go down to 3 out of 19, now you're up to 42. I'm sorry, you're up to 18 positions. So the ones that everybody holds, the ones that are popularly held are, those, and then to a lesser extent, those, and then to a slightly lesser extent, those. So that there would be the top 14, the top 23 through that position there. So roughly a quarter of the portfolios would hold those 23 positions. And obviously not the same portfolio. I mean, you'd have some portfolios having 2 of them, and some portfolios having all of them, and somebody maybe was just one of, one position out of that list. That was the exercise that I suggested we do, that I started off because, and the reason I'm doing this is because selfishly for our family, we're rapidly heading towards retirement and mentally shifting from total return investing as a mindset to trying to generate more current income. And since I'm new to that, I wanted to see what other folks were doing. So I asked that question. That was how we got to this point, was if you were kind of shifting focus to more current income as a priority, what would you be looking at right now?
Ray, I'm kind of surprised to see that there's only one mutual fund in this thing, and that's SCHD. Is that correct?
I think O is is SCHD a mutual fund or ETF?
I think it's an ETF, isn't it?
Yeah, I think so. Yeah. I think O is an ETF too, isn't it? Or is that a company?
No, it's a
okay. I know it's a real T. Is it like a REIT or something?
It's a REIT. Yeah.
Okay.
Yeah. Not surprised. I kind of thought there would be more ETFs in this list.
Yeah, I mean, one thing maybe like it seems like there's just there's almost more ways to package individual stocks than there are stocks at this point. You know, I mean, it seems like there's 700 ways to go. Like you could actually have SPY for the S&P 500 if you wanted, or you could have Vanguard's version of it or whatever. You know, you could have, there's probably 10 different ways to get after common plays, like dividend focused or aristocrats or any of that. So that could be part of it.
Ray, I'm a little surprised that I don't see I bonds, and I'm wondering how many people have owned I bonds.
I don't know, because actually nobody did submit that, but I was one of the participants and I didn't list my I bonds either.
I didn't list my bonds either, but I bonds in general are very attractive, as I understand it right now. But the problem is you can only buy so much of them. You know, you can only buy what
10,000 a year.
right? Yeah.
10,000 a year per basically Social Security number or tax ID number.
Yeah, that's the downside of it. But you know, certainly worthwhile doing. You know. Well, I'll just just to get the conversation going, I'll give you my rule of thumbs that I used when I submitted my list. And I have disobeyed my rules, to be perfectly honest. I try to make the portfolio at least 20 stocks, and 30 is way too many for me, but I have gone up to 30, well beyond that, in fact, and I should not. And the reason is very simple, is for diversification purposes. Any one particular stock goes south, I'm not vulnerable, you know, and especially in this kind of environment where, you know, if there's going to be a dividend cut on one of these stocks, it doesn't affect my income too badly, you know. For example, AT&T, you know, they just cut their dividend. So, you know, I'm taking a hit on that one particularly because I happen to own that one. But on the whole, that's worked fairly well for me. It's a lot more work to keep track of them and to keep, you know, make sure that I'm aware of what's going on with them. But I actually enjoy doing it. So it's not really a burden for me. So I don't know what everybody else does, but chime in, as they say.
Well, I'll chime in with an observation or I guess more of a question, because it was mentioned that there's only one fund, which is the Schwab fund in that list. Ray, don't make that go away and don't show us your tax brackets.
Well, I didn't. Did it come back?
No, you're fine. You're fine.
I was actually just pulling up the tax brackets that, because we were talking about 22, 24, and the 22 kicks in at really a lot lower than I was aware.
Yeah.
Yes. But my, I guess, question that I'd love to hear people's thought on, if you look at what Ray's collected here, what did you say, 23, 24 positions? 23
there up through 5 out of 19.
Okay, so let me say, let's consider the 22 stocks here. They've kind of been selected by the wisdom of the crowd. So probably none of them are horrible. How would you decide, maybe in your case, Ray, or anyone's case, should I go out and buy these 22 stocks, or should I just buy SCHD, which has, I'm sure, 100 plus stocks? Because I saw this earlier, because Ray set it up in case he had technical difficulties. I was able to actually punch it into a portfolio, and the dividend return is very close if you buy all the individual stocks or if you bought SCHD. So the yield was like a difference between 3 and 3.2, not huge. So my question is, what would you recommend how would you make a decision to say, I'm going to buy these 22 stocks versus I'm going to buy SCHD, which gives me a similar yield and gives me probably all of these stocks plus more?
Well, I'll chime in on that. That really boils down to, Tom, about doing a valuation. In other words, you have to take a look at each of the stocks in the portfolio and decides whether they are undervalued or overvalued. And most of those stocks right now are overvalued, to be perfectly honest. But there are stocks that are undervalued, and those are the ones that I would be looking at real hard. For example, I was one of the ones that I think submitted Allstate. That's an undervalued stock in my portfolio, and I can certainly. We probably won't have time at this meeting, but I can certainly go through my logic on how I do valuations on individual stocks, and it's basically looking at what's undervalued in that sense. But everybody, I'm sure, has a different approach, and so it's really great if we can have everybody chime in and tell us, how they're going about doing their valuations. Is it a newsletter that they're that's recommending it and they're buying into that? That's fine too. I mean, there's nothing wrong with the various approaches, and everybody's going to have their different, and that's what we're here for, is to share our knowledge and our ideas. That's it. So I can certainly go through the valuation process I've used, but
that's a real helpful insight, because I just clicked on that, and again, because I had a chance to type it in, and based on that thinking, which makes some sense, 5 of these stocks are considered undervalued. So most of them are not something one would buy at this point. So that's a useful percent.
Yeah, well, remember that some of these stocks will start to decline in value. From a macroeconomic point of view, the fact that the Fed has boosted the basic income, or the basic rate, that there's 2 components to income. One component is what we call risk-free, okay, and that is basically a 10-year bond, and that's right now close to 3%. So what is the risk premium that I would pay to get something over and above that? In other words, if I'm going to buy, let's say, Coca-Cola or Johnson & Johnson, I expect them to pay me a higher return because I'm taking a risk. And so if the basic rate, the basic risk-free rate has risen from 1% to 3%, then I expect the risk premium for Coca-Cola to be much higher. And because of that expectation, most people will look at Coca-Cola and say, this is too risky. I will not buy it right now. So the net result is that the price of that stock starts to drop, and it gets down to a point where the payout, the cash flow, or the what I would call the dividends, gets to a point where it's attractive for me because I'm taking this extra risk in this particular stock. And that's starting to happen now in the market, because as the market slows down, people get nervous and they sell their stocks. And as a result, the price of the stock drops. But the dividend is fairly constant. It may be cut in some of these companies, but not many of them. And so that's the forces that I see at work. And that's where I see as the economy slows down, I see that as a great opportunity. I see that as an opportunity to increase my income dramatically, if assuming I have some cash to do that with. And so that's a big deal. So that's why I keep saying at the bottom of a recession, it's like dancing in the streets for an income investor. So it's the opposite of what you would normally think of as a capital gains investor. So that's that's all I'll say about it. So and dividend stocks are an ideal vehicle for doing that. Anybody else want to chime in with what they're doing? Andrea, I see you typing some stuff, but you might want to unmute your mic and just say some things.
The reason I don't is because I really don't know much. So I'm just chiming in my thoughts as they're going through my head and as I'm learning also. So I've heard different I've read different articles in the media about how and you can't believe everything you read, but like companies are increasing prices of consumer goods in order to keep their shareholders happy, which is making a lot of people unhappy who can't afford these price increases. But as I read these articles, I kind of combine them with what I'm trying to understand about the stock market and how that works.
Well, we're here from the perspective of from the point of view that I would like to have more income. I'm a retiree. I live off my income, and so I'm always looking for a way to increase my. So I'm a shareholder's perspective. Yes, that's true. Prices are going to jump up there. There's no question about that. My gardener just increased his monthly rate $20 here for my that does my cutting my grass and so forth. But and when I talked to him about it, he's got real problems. He's got his gas prices are going up, his transportation costs, his feed, there's a whole bunch of reasons why he's being affected. And that's going to affect the price of stocks as well. No question about it. But dividend stocks in general are they offset inflation. They really do over the long pull, not the short pull, but in the long pull, they do. So.
Yes, yeah, I agree. And I also know from a marketing background that a lot of consumer goods are owned by just a handful of companies. And so some of these high dividend yielding stocks that are big names like Johnson & Johnson, et cetera, there's a little bit of a connection there, but I understand what you mean by the income focus and appreciate that.
There's another thing that we should all understand here too as well. There's all kinds of companies. There are startup companies. There are growth companies that are starting to grow. There are companies that are reaching maturity. There are companies that are actually in decline. And quite frankly, you'll find most of the dividend companies that, for example, in this portfolio, these portfolios you'll see, these are mature companies. They're not growth companies. They're not companies that are going to, double and triple their sales overnight. They just simply are mature, cash flow producing organizations. And that's what makes dividend investing so attractive to me. Granted, we could all buy Twitter or whatever it is, or Google or some other, and you'll get a very high growth. That's true, and those are great for capital gains investors. But for income and for sustainable, steady income, you can't beat dividend stocks. Plus, you are only taxed at a 15% rate. If you're in a high bracket, you'll be taxed at 20%, and that's the highest you'll go. You don't have to worry about huge capital gains, selling a large amount of the portfolio. So I see dividends as a critical part of all income portfolios. Now, whether you buy it through a mutual fund or a ETF, that's fine. I don't have any quarrel with that. But dividend stocks are a major portion of a portfolio.
Andy,
Yeah.
this is Chuck Smith. I wanted to share a little exercise I went through and get your comments. It's I've never looked at stocks this way, but I wanted to share something and see if there's value from this. It's very interesting because I went through and annotated the ones that were on Ray's list into my spreadsheet. And I just wanted to show you something, food for thought.
Okay, sure. Do you want to share your screen?
Yeah.
Okay, Ray, you want to stop sharing and.
Let's see, is this the one I want? This one. Can you see the spreadsheet?
Yeah, we see it. Yeah. Yeah.
Okay, so what I did was, it's all about dividends. So I went to the David site, I guess it's dividends, dividend champions, contenders and challengers. It's the website that's got, at last count, it's got 700 stocks in it that have paid dividends for at least the last 5 years, right? And right here is the website for that.
Mm-hmm.
So anyway, in that table that they provide on the website of those 700 stocks, they provide information like the dividend yield here, recent increase in dividends for 1, 3, 5, and 10 years. So what I did was I built a spreadsheet. Here's a spreadsheet that happens to have all of those various 700 stocks. And then they provided this information across the top here, the years of dividend growth, et cetera. So then what I did was I said, I want to look at least stocks that have greater than average performance of everyone else. So I took all of these criteria and then I computed the average and got these numbers that you see down below here. And then what I did was in Excel, there's a conditional formatting function that allows you to look at each cell and format it based on criteria. So what I did was I started for each of the stocks in the 700, I then highlighted which one of these exceeded the average for that particular criteria. So in the case here for dividend yield, the average over the 700 stocks was 2.44% yield. And you can see these ones here are all highlighted. They were better than that average, right?
Okay.
So I did that for all of the 700 stocks for these categories. And this is just showing you a highlight of what I did. So you take all of those stocks, and what I did was for each one, for all these categories, you can see they're highlighted in pink or whatever here. If they exceeded the average. And then I said, I really want the best of the best. I want stocks that meet all of these criteria, or that are better than average. And that's when I came up with this list that you see here. And it was really based on just the first 4 categories. These two here, I had a bunch of NAs where there wasn't available data for them. And so I sort of discounted them. This is the actual, since I didn't have a formal watch list before, I looked at this based on this information. This was the watch list that I submitted that I'd be interested in.
Oh, okay.
But even if you look at, if I discounted the 5-year and 10-year growth because they didn't exceed the average versus all the other 700 stocks, I still highlighted them here. And as you can see, most of them still fall into this category of ones that were above average for everything. So it's interesting. This 25 stocks or so are have higher, they've performed higher than the average from the rest of the 700 in total. And so when I looked at the list that Ray did, out of this 25, just doing this type of analysis, only one was Texas Instrument, which I highlighted here, met all of those criteria.
Okay.
So it's just a different way of looking at it, but it's, it was very dividend oriented. And I looked at this information that they reported
Mhm.
and tried to say, I want a stock that does better than average, right? And it's interesting. I came up with just 25 that did out of that 700.
Now,
And
Chuck,
then I
when you-
used,
oh, go
yeah.
ahead. Go ahead. When you did the sort, did you that particular spreadsheet allows you to do what's called the Chowder rule? Did you try to use that criteria?
No, I didn't use that.
Okay. All right. Go
That's
ahead.
something I probably could. Another thing that I did, just to comment, Excel 365 has a stock data type, and that allowed me to go in and I filled in all this information here using that stock data type. So it's
Wow,
where
very impressive, yeah.
Excel goes out to the industry and it grabs all this information. So if you look at this one, it says current price up here in the formula. That's a Excel stock data type that says B2, which is the the name of the company, and then it goes and gets the price and it fills it in. So I actually grabbed all this information just out of curiosity for all these stocks as well.
Somebody's commented, can you enlarge that a little bit on the screen a little bit? Because yeah, there we go. Yeah, that's better. Yeah. Okay. Go ahead. Sorry, I didn't interrupt you, but.
Well, I was just saying it was, I use, it's interesting. The stock data type's a powerful function. I'm not sure if it has all of the criteria that you can grab from Google, but it does, it does have some things, and not as much as I'd like to have, but you can see here's just some of the items that were there. Mm-hmm. What I also found out though is that the website, the dividend website, some of the names of the companies don't match what's on the New York Stock Exchange, for example. So when I went through and tried to tell Microsoft, okay, find this information for this company, some of them it came back, they couldn't find it. And I found out that it was because the dividend site uses a different name for the company versus the main, the stock exchanges. So I had to go in and change the names to match what's on the stock exchanges, and then Microsoft would find the data. Uh-huh. But anyway, this was just a interesting process I went through, just looking at dividends and some of these items here, just this criteria, mm-hmm. to kind of see what would fall out.
So now this spreadsheet is a snapshot in time, right? Is that what I'm understanding this to be?
Yes. I actually, let me look at my procedure here. When I did this, they still haven't updated that I know of, but I think it was, this was as of March 31st. So I think I did this April 10th or something. I forget what day I did it, but anyway, I don't know how frequently they update it, but.
I think it's monthly, isn't it, Chuck? If I remember right.
I think so, but I didn't know if it was more frequent, because I've only grabbed it here and that's the date they have, and it hasn't changed today yet. So
I've done some exercises using those spreadsheets myself, but I do a little different approach. I take the price to earnings ratio, which is I think the column M you see there, and I do the inversion of it, which is the dividend yield, or the yield. Mm. And the reason the logic behind that is, if you have a 6% yield, that means that your well, I'll go back to my little talk about the minimum reason I buy a stock is I have to buy something that is above that pays a premium. Okay, so if I'm buying, say, if I'm going to make a choice, I'm going to buy something. I've got a 10-year treasury over here, which is paying almost 3%. Okay, so if I'm going to buy a dividend paying stock, I expect to be rewarded for something higher than that. And it turns out that about 6.5% is on average. So there's a, and that's the inversion of the price to earnings ratio, basically. So when I do a screening, what I do is I screen for 6.5% as a starting point. And then I start to look at, what is the cash flow? What is the growth? What is the, what is the value of this particular stock? I do my valuation based on that. It's a pretty primitive way of doing it, but at least it makes sense to me from a economic point of view.
What's that called again?
It's just the price. It's the inversion of the price to earnings ratio. If you have a PAE of 15, for example, if you invert it, it's 6%, 6.5%, roughly speaking.
Okay.
Okay. So in other words, I expect my stocks to have at least a 6.5% return on average. If they don't, then I take a long, hard look at it to see, should I get out of this stock? And by the way, if you plot that yield over a long period of time, and you look at it, you match it up against the cash flows, you can pretty well tell when a stock is overvalued or undervalued.
Interesting.
So I would encourage you, Chuck, to continue to use this. This is excellent what you're doing here. I'm told that the Chowder rule, which is I think also included in this spreadsheet somewhere, I don't remember exactly where it's at, is a good criteria that a lot of people use.
Okay, I'll look into it.
Yeah.
Could you say what the Chowder rule is again, please?
I don't have it in front of me, but if you just Google it, the Chowder rule is a criteria for measuring the performance of a company with a dividend growth profile, so to speak. I don't have it in front of me. I have to look it up. I'm sorry.
I think the Chowder rule is the rule is really more of a number, is just the current yield plus I don't know if it's a 3 or 5 year dividend growth rate. So it's just 2 percentages added together, and people say it's good if it's 10 or above.
I mean, there's some of these stocks in this list, Chuck, are pretty good. There are some of them on my watch list. Home Depot, Texas Instruments certainly is on my list. I'm trying to look at some of the other ones here.
Got a good list, Andy.
Well, I don't know where. I'm not so sure that it's that. It's Snap-on Tools. Yeah, that's always been on my list, but the last time I looked at it, it was overvalued, so I decided to wait on it. Okay.
Anyway, for what it was worth, I thought I'd share it.
Outstanding. Yeah, it's very good. Yeah.
I was going to point out on that list too, how heavily it leans towards financials.
Yes.
Yes, that's true.
Which can deliver more smoothness in theory than somebody making a product and going through all that stuff,
I noticed that too. I'm really happy to see that my ignorance caught one thing that looks like it's a reasonable income producing stock, which is T. Rowe Price. It caught my attention when it was above 140 a share, and then I was cross-checking with different articles that were, either that were promoting it as a good investment. But I've just been watching it, but haven't been paying close attention recently, but it's nice to see that I picked one out of I don't know how many. Anyway,
I looked at T row myself. It is undervalued. That's from my criteria. The thing that concerned me about T row was it's highly volatile, and so maybe it'll go a little lower before I would take a position in it. So, but yeah, it's what's its yield here? It's over there. Yeah,
3.9.
yeah, 3.9. So that's not bad. I can bring up fast graphs and show you, what that stock looks like from a point of view, if you like.
Do a lot of here.
yeah, that would be great, but I don't want to take any attention away from the overall.
Well, I think we're here to educate ourselves, and well, here let me just I'll bring up fast graphs and I'll show you some very basic criteria. Let me hold on here. Where am I here? Oh dear, what did I do?
Whoops, sorry about that.
Uh,
Chuck, it looks like Jack is hoping that you'll blow up the list again.
Well, I stopped sharing so Andy could share his.
Oh, okay.
Oh, do you want
Okay.
to? I'm sorry. I'll stop sharing here.
Okay. Sorry about that.
Yeah. Go ahead, Chuck. Do you want to continue? I'm sorry. Go ahead.
Do you need it larger?
Do I need it larger?
Well, someone said they wanted to see it, that it wasn't large enough.
It was Jack.
Is this
Maybe
okay?
I'll type in.
Jack, I asked.
Yeah, he said larger, please. He must be muted.
Yeah, before it was very large. It covered the whole space. Now it's just a little, I was going to take a picture of it, but it's too small. I meant because before it was just that and not the person's picture of the person. It was just this because I was going to take a picture of it.
Can you see the table now? Is this good enough?
No, I can't because it's just too small. Before you didn't have the speaker's face. It was just the stocks were listed. In other words,
Chuck, by the way, if you want, if you can send me the spreadsheet, I'll post it so that everybody can look at it too.
Sure.
After the meeting. So just as a side note.
Okay, great. Yeah.
Yeah.
To study it. It's just too small. I can't take a picture of it. It's just too small.
Is it your settings for your Zoom stuff? Because I am pretty big. I mean.
Let me see if I try. Okay. That's yeah. Let me see here. Yeah.
Are you on Windows, by the way?
Yeah. So I'm just a lousy computer person. Yeah, I took a picture, but it'd be good to email it. Yeah.
I'll send it to Andy and he can distribute it. You guys can play with it.
I'll post it on the
Great.
site. Yeah. Just
Thank
send me the spreadsheet now. Yeah, be sure don't put anything in there that you consider confidential, of course.
Oh yeah.
Yep.
Yeah, no.
So
should I stop screen sharing? You ready, Andy?
Well, is there anybody else that has do you have anything else that you'd like to comment on this? This is excellent, by the way. This site is free, isn't it, Chuck?
What is that?
It's free, isn't it? The site that you downloaded this from?
Yeah.
Yeah. It's a very good place to start in terms of filtering out stocks.
That's the site right there.
Okay. Yeah, send us the spreadsheet and we'll distribute it to everybody.
Chuck, if you just cut and paste it in the chat box, then
Sure, I can do that too.
we can make a note in case we can't write fast enough. Thank you.
You're welcome.
Okay, Ray, did you have anything else you wanted to add but to what you were talking about earlier?
Not really. I mean, that was the extent of it. And then of course the question is, what to do with that? Do people want to maintain it? Is it worth kind of going once a quarter and doing a snapshot to see if it's changed? That kind of thing, which doesn't need to be answered right now, but just to think about what we might want to do with that database.
I think it was a useful exercise, and if you're willing to update it every quarter or half year or something, I'd certainly be willing to submit my data appropriately.
Yeah, I mean, if everybody submits it, I'm happy to do it kind of once a quarter. And I also initially set it up where we still weren't sure if we wanted to be able to go back and see, to have it completely be anonymous, like it was presented here, or if people wanted to, if they saw a particular portfolio and they're like, oh, that person thinks just like me. Or if you wanted to know, basically the links you have to go to kind of provide anonymity. If people thought that was not necessary, then people could explore that. But the once a quarter, the only thing that's really important is just simply, like I said several times in that email, is to cut and paste. Either ideally just cut and paste that single column, because then I can, in an email, I can grab that and stick it in, and all the data manipulations and moving stuff around just become a lot easier than if you put commas or a long text string, or some people cut and pasted essentially pictures of it, which you can't cut and paste from that into a spreadsheet. So the only thing is really just to submit it. And when we do it, if we do this again in a quarter, I'll send out that same reminder email of here's the format, super simple. And we can see, maybe we'll get more than 19 people. That might help, grow the data. Maybe it'll change what we actually see. And maybe it'll change a little bit as it looks like, rates are going up, and at least the market is testing some supports and stuff. If anybody's doing any, it'll kind of see if anybody's doing any shifting in their portfolios. That's really all I had.
Okay. Well, yeah, in general, for example, I'm getting all excited about Allstate. Well, I'll tell you what, let's go to T. Rowe Price, since we've talked about that a little bit. And then let me see if I can share my screen here. Stop sharing. Okay, Ray. Okay.
Oh, I'm sorry.
Go ahead.
I don't think I'm sharing. Am I sharing?
No, I was sharing.
Okay. Yeah.
Okay, there we go. How come that's strange. Why can't I? No, it's not what I want. Oh, dear me. Let's see.
I would just throw one thing out for T. Rowe Price as you bring it up. One reason it's attractive on yield right now is because it's off 50% in price in the past year, less than a year maybe. It looked like it had a double top around January. Yeah, kind of November and through January. And it's now down to kind of a support level right around where it was in 2018. So that's two ways to get to yield. Either you deliver a lot of dividends, or you have your price collapse,
Quick question for, I think, Tom Gifford. When Ray was showing, when you were talking about the 23 stocks in question, and I think you said there were a total of 5 that were undervalued. And I'm wondering which 5 those are and what criterion you used to say that they were undervalued.
Sure. I had it up on Simply Safe Dividends. And I had them in there because Ray shared this with me earlier. So I just for fun put it in there. And if you give me 30 seconds, I will pull that up again and read you the 5 that were according to Simply Safe Dividends way of determining timeliness.
Okay,
The
thank
ones that
you.
were undervalued. And basically the 5 are Intel, 3M, BlackRock, Verizon, and Amgen were all currently categorized as undervalued.
I'm going to share my screen here. We can talk about some of the stocks.
Did you get those, or could I repeat them?
Give me the, let's go to T row first. I think
I got your 5, Tom.
Cool, thanks.
Could you repeat them, please?
Sure, and again, this is Simply Safe Dividends evaluation criteria saying that these may be undervalued. Intel, INTC, 3M, MMM, BlackRock, BLK, Verizon, VZ, Amgen, AMGN. Okay, Andy, back to you.
okay. Does everybody see my fast graphs chart here?
Yeah.
Okay. Let me explain a little bit about how this works, because it really is pretty fundamental. What I'm showing here is the earnings curve for T row price over the last 20 years. And what I've done here is the dark shaded green area is the history. In other words, it goes back 20 years or so. And then the light shaded area here is the estimates for the analyst community for the next sometimes 2, sometimes 3 years. And so you can see, for example, the investment community is showing, for example, that in 2022, their earnings will be down by I guess earnings of $10.55, and then it'll slowly rise for the next 2 years. And this is based upon, well, let's see, if you go to the analyst record, here is a chart of the analyst record. And it shows you the number of analysts. For example, across the top here, you can see there's 22 analysts that looked at this stock 2016, 17, and so forth. And what this does is it measures the performance of the analyst, how well they did in estimating the earnings for this particular company for the next 2 years. And as you can see, the little green flag here indicates that they were pretty good. They were within, say, 10% of the estimate. So the analyst community has a pretty good handle on this particular stock. So their track record is pretty good. I mean, so we can put a lot of credence into the forecast that they have prepared. So if I take this and I go here and I add the price to this stock, there it is, the price. You'll notice that the price follows the earnings pretty regularly. Now, it does deviate from that from time to time. For example, you can see here that the price of the stock got much, much higher than the price to earnings ratio. For example, the price to earnings ratio for this particular stock is about 15. And you can see here, during, let's see, it looks like August of last year, it got up to a price to earnings ratio of about 18. But in general, the price of the stock follows the earnings on a fairly consistent basis. Now, here's the bottom of the COVID recession right here. And you can see that the price to earnings ratio for the stock dropped down to somewhere in the 10 to 11 range. And during the Great Recession back here, it dropped down to about a price to earnings ratio of about 14. So what this chart shows you is that price does follow earnings on a regular basis, but it does wander from it quite a ways. And so one could assume that, for example, that here is the current price, which is around $123. It's grossly undervalued compared to the price earnings ratio history for a stock of this nature. Now, we can do one more thing here. We can put the nominal PE ratio in here. The nominal PE ratio is the ratio of this stock itself. It's not the what's called the intrinsic price to earnings ratio. In other words, this is the history of what this stock has done over the last 20 years. So your PE ratio here is something on the order of about 20 times earnings. And you'll notice that back here, it was overvalued, but over here it's undervalued. So what this says is that this is a highly volatile stock. Its price moves quickly, and but at the same time, it's very undervalued right now. Now I can take this one step further, and I can apply the dividends to this stock, or excuse me, they're not the earnings, but the dividends. And this is the white line is the dividend history for this particular stock. And the first thing that kind of jumps out is that from a dividend income investor point of view, it cut their dividend here. It rose again, cut it here, and they cut it here. And it's expected to be cut this year. So, so that's why the stock has dropped in price, because the expectations are that the dividend will be cut and the earnings will be cut. And so the market has perceived this price of this stock to be coming down, basically based on the sentiment of the stock. So if one were to take a position in this particular stock, I don't have any idea where the bottom is. I mean, I don't think anybody knows that at this point. So the solution is it first of all, the right amount of dividend? It probably looks like it is. It's got a fairly attractive dividend. But the best thing to do if you want to take a position in this stock is to dollar cost average into it. And so, you know, you could take a position and then look at it, say, 3 months from now or 6 months from now. And if it's lower, you buy some more. If it's lower again, you buy some more. So what is the risk here? Well, let's look at the cash flow. I'll just look at the operating cash flow for this company. And this shows you the cash flow per share for this operation. And you can see that the dividend is well covered by the cash flow. There's no point at any particular point in time where this company's dividend has been vulnerable to a cut because of the cash flow from operations. Now that's, go ahead, sorry.
Well, what's fascinating in terms of the dividend picture is how it has never gone down below its past history.
That's correct. Now,
so
yeah,
there's a reasonable belief, especially with it being around for so long, there's a reasonable belief that if a person doesn't need the money tomorrow, that it's gonna go up and down like it has in the past, but the trajectory or the expectation is that it's still going to climb upward.
Yes, that's correct. So if you're a capital gains investor, that may be an attractive argument, okay? But if you're an income investor,
Gotcha.
where you want a sustainable stream of income, this stock is not as attractive, let's say, as some other one would be. I mean, these are all very gray areas we're talking about. And so, you know, you could make a case that says, well, look at here, here's the dividend yield right now at in 2020, and that it's going to take a sharp jump in the dividend here. So, you could make a case that says, well, I'll if I bought it here, I would have a very nice increase in my dividend.
Thank you.
Now, let's take this one step further and look at free cash flow, because free cash flow is what they really have to pay the dividends with. And if you go down here, and by the way, you can do this on any balance sheet, by the way, you can see that the dividend, which is the white line, has never gotten anywhere near the cash flow, the free cash flow. So this cash, the dividend is fairly safe in this particular stock. Now, the question in my mind is, well, okay, why did T. Rowe Price cut their dividend here? And why did they cut it here? And why did they cut it here? If they did that for some reason other than for cash flow purposes, there must have been some other reason that they chose to do that. So this says to me that this particular company is not as shareholder friendly, I mean, to income oriented shareholders, as one might expect. They may be more friendly to capital gains oriented investors, but to an income guy like me, I would have to dig a little deeper into this stock to determine what caused these cuts here and here, because I'm looking at sustainable stream of income. That's my stick, as they say.
Thank you for kind of pointing that out, the distinction with income and dividends.
Yeah, that's fine. It's dividend investing is somewhat different. It's really a subset of value investing in that sense, in one sense. Okay, I just want to stop sharing my screen here. Would anybody else like to look at a stock here while I'm on this, or shall I just stop sharing?
Andy, I just had a follow-up comment on that. I think, yeah, and because T. Rowe has cut their dividend several times, these guys will never make the list of dividend aristocrats, because and it makes, and I think your point is accurate here. They're not targeting income-oriented investors despite an attractive yield here. That doesn't seem to be historically been their focus. So
yeah, and that's, there are companies that really do concentrate on their shareholder friendly and on the income side, and there's those that are not. And so discerning which ones is a valuable process that I think an income investor needs to do when they're looking at it. I mean, just let me quickly just show you J&J, because it's a kind of a poster child for what an income investor looks like. Let me go here, and I'll go back to earnings. Now look at that. That's incredible. Now, Andrea, going back to your comment, yeah, they're raising their prices. There's no question about it. And they're trying to offset the inflationary environment. But from a shareholder's point of view, from an income shareholder's point of view, I'll stick with this stock for a long time. And you can see that the dividend has never been cut. So it would appear on Chuck's list year in, year out. And here they actually, the earnings dropped from here to here, and they never even dropped during the Great Recession. And if you look at it from a free cash flow point of view, they're rock solid.
That's awesome.
Yeah.
It's awesome that you use T. Rowe Price and Johnson and Johnson to kind of show us this. Thank you.
Yeah.
So, Andy, the current yield is over 5% on Johnson and Johnson.
I can't see it because all your guys are in the middle of this. I can't.
See, on the one column on the right there.
Yeah, I know where it's at. I just can't see it because all your faces are on that right side of my screen. I can't.
It's 2.5% on my screen.
2.5%.
Yeah,
okay.
that's why I'm asking the question, because right now it says 2.5%. On the previous screen, it said 5%. So I was wondering what that was based on. Andy, just go to your view and get rid of all the faces.
How do I do that?
Go to view, and where it says where it shows you the possibility of the gallery on the margin or on the right, just get rid of the gallery. You just want the speaker's face or none at all.
It's in the upper right corner, Andy. That's where you find view.
It's on the Zoom screen, not on the fast graphics.
Right.
And I see.
It's got a little box with 3 dots above it, and then it says view next to it, and you click on that.
Okay, can I hide the video panel or hide?
Well, I have standard, and all the images of people is on the top of the screen. I don't know if that'll work for you, but
You can also stop your share.
well, it doesn't want to do that.
Do I have to stop sharing, I guess, to do that?
No, I think you can change the view.
Enable, let's see, I got hide meeting console.
No.
Hide video panel.
Yeah, maybe that's
there it is. All right, there we go. Yeah. So yeah, the correct for this particular stock at this particular time, it's your dividend is 2.5%.
So what was the screen earlier that showed greater than 5%? Can you just back up and look at the other screen you had?
Okay. That was Johnson & Johnson. No, it was.
Yeah, it was Johnson & Johnson, yeah.
It's 2.5% there. Okay. And I'll go back one more.
Yes, please.
All right.
I didn't see in any of the screens.
Yeah, I don't see it either. Wait a minute. This is going back to T. Rowe. T. Rowe price is 3.
Okay, forget it. I was confused about something maybe.
Now let me back up here because we talked about yield. Over here on the right hand side, see where it says earnings per share yield? That's the inversion of the price to earnings ratio, and it's above 6.5%. So in my little criteria, I say, okay, this stock is worthwhile. And you'll find that any stock that has got a 6.5% earnings yield will be somewhat below 15 times earnings. That's just a kind of a general rule, because it's the inversion. It's just simply the mathematics. Now, there's more theory to that than I'm talking here. It would require me to do. I'd have to do a presentation on what's called earnings risk premium, which is kind of a theoretical, like not a theoretical. It's an economic criteria that underlines all this logic for this. Maybe I'll tell you what. I'll make a note to myself. I'll dig out my slides on ERP and maybe I can do them at the next meeting or something, because it's important to understand that when you're investing in stocks, you are taking a higher risk than if you're buying a bond. And you need to understand what that risk criteria is. I mean, how much more should your expectation be for buying a stock versus buying a 10-year bond? And that is changing. That is changing right now because, you know, as the Fed has cranked up the 10-year bond, it's up to 3% now. So therefore, your risk premium should rise as well, because you know, you're just not getting your money's worth, basically. And so I expect the price of stocks to drop dramatically, especially the ones that are mature companies like T. Rowe Price or Johnson & Johnson, because no rational market, no rational investor would take that risk unless they could be compensated for that. So, anybody else want to share what they're doing?
So what does TLT look like under this circumstance then?
TLT?
Yeah.
I'm going to have to drop off, guys.
Okay. Ray, thank you. Thank you very much for all your effort. I guess we'll be talking a little further later on, I guess.
Sounds good.
Okay.
Ray,
Thanks,
just
sir.
a quick question. Are
Sure.
you going to share those spreadsheets with us?
Oh, absolutely. Yeah. Yeah.
Okay, good. Thank you.
Of course.
So TLT, the bond fund. TLT.
I'm sorry. I can't do funds on fast graphs.
Oh, that's right. Sorry,
Okay.
you said that
This is
before.
just stocks only, unfortunately. Yeah. Would we want to talk about any of the other stocks before I stop sharing the screen? Anybody want to have a question?
Well, that's a pretty gloomy forecast you just gave, that all these solid companies are going to drop in value.
No, I'm not. It just gives you a better understanding of what's going on. Let's take a utility, because that's probably a classic. UGI. I know, John, you and I have been changing emails on that for a while. This is a gas company. I think they're based in the Midwest somewhere. And they're a utility, basically. So down here, if you look down here, they're they don't show any rating here, but I think they're classified as an A-rated company in terms of their credit rating. And this shows the performance. You can see that the blue line is the price to earnings ratio for this company over the last 20 years. And you can see there are periods here when the price grossly is way above what their earnings are. In fact, you can see that the earnings dropped here, and then of course the price of the stock dropped accordingly. But they never cut their dividend. Their dividend continued to grow during that period of time. In fact, during the last recession here, they never cut their dividend. So this, from an income point of view, is very attractive, and it pays a 4% dividend, and its earnings yield is well above 6.5%. So that's the good news on the stock. But like everything else in life, if you look at the amount of debt that they've acquired, it's huge. Let's go over here and I'll show you their debt structure. All right, let me go over here, long-term debt. Yeah, and then I'll go down here and I'll put in the income stream. Let's see if I can find that. Free cash flow. Well, let's see. Let's back up. Let's go down up here. Let's do this. I'll use earnings before interest and taxes. Okay. So let's look over here on the right-hand side. For example, this is the debt, the red line, right? And this is the amount of cash that they have to service the debt. In other words, the ratio between the amount of income that they have versus the debt, the total debt. When this ratio gets to be 4 or 5, that's huge. That's a huge number. Now, what they did was recently they started to service that debt and they increased their earnings to a point where that debt does not look nearly as bad as it did before. And the reason for that is they made an acquisition. So when you're looking at this company during 2019, you wouldn't touch this thing if you were an income investor with a 10-foot pole, because they're over leveraged, grossly over leveraged. And this, by the way, is not a valuation criteria. This is a credit worthiness criteria, basically. So this company would not look attractive in this particular point in time. But the fact that they made this acquisition and now their earnings have jumped up dramatically, now they can service that debt fairly easily. Now, they haven't decreased the debt much, but the fact is they are now in a better position to be able to service that debt. So therefore, their risk from an income point of view has diminished. So going back to the fast graphs version of this, if you look at the free cash flow, you can see that they're free. They don't have a lot of free cash flow. This whole period of time, from here to here, there was no cash to pay off to pay the dividend. Yet they continue to pay it. So where did the cash come from to pay this dividend? Well, it's obvious. It came from the debt. In other words, they borrowed money, used the money to pay the debt or to pay the dividends. It's as simple as that. So this is a utility, and so the best way to look at a utility is to look at the operating cash flow rather than the operating cash flow is fine. You can see that here. So from an income investor point of view, UGI looks attractive because they cover their dividend, their cash flow is covered. They're deleveraging themselves, and so this is a fairly attractive company. So I'll stop there. I've gone on way too long.
No, that's very helpful, Andy.
Yeah. Okay.
So Andy, can I ask a question?
Yeah.
So you heavily get into the dividend growth, the 10 for 10s, you call it, part of the market. So how do you expect them to be performing in the next few months with the new Fed action starting in a couple days?
You mean the increasing rates, you mean?
Yeah, I mean, right now, I don't think people fully understand what we're going to be going through. We have, inflation rate that's higher. It hasn't been this high since December of 1981. We're basically it's at 8.5% now, which is absolutely crazy when we have a Fed funds rates of 0.25. This has never happened in history.
Yep.
At the minimum next month, most analysts have said they're going to raise the short-term rates by 0.5 percentage point in one fell swoop in a few days. And, what a lot of people don't realize is the economy actually contracted as of the first of the year by 1.4% on an annualized rate. So we're already contracting, and now they're going to raise the rate to try to fight this inflation, which is going to be hard to do when you have $105 oil prices. And I think the volatility that we saw in May is just going to get worse. We're going to see humongous swings in the next few months.
Yeah, I believe you might have to agree with you. Let's take a very, very conservative stock, say a utility stock. Their revenue is fairly constant, right? They They generate electricity or they generate gas and they deliver it to their customers, and the customers continue to use it year in, year out, no matter what. So their revenue stream is fairly constant. So, and they're paying a dividend at a certain rate. Let's say they pay a 3% dividend. What's to happen with that particular stock from an investor point of view? Well, if inflation skyrockets, then there's going to be a lot of pressure on that particular company because people will expect a higher yield because the marketplace demands it. So the result is the price of that utility stock will drop. It will drop dramatically if inflation continues to be a factor. Yet when you look at utilities or you look at some of these dividend paying stocks, they haven't dropped that much. And the reason the only logic I can see is that this inflation is terrible right now, but it can't continue this way. It will have to drop. And so I think we're heading into a recession, and it's going to be an ugly, ugly recession. So if you're in a cash position now, you're going to buy dividend paying stocks at the bottom of the recession at bargain prices. And so I don't know, I saw Kippinger's forecast for the economy at the end of the year. They're saying a GDP growth of 3% as opposed to 8%, which is what's being talked about right now. And that's probably what will happen, I would guess. That's, as they say in the old cop movies, that's my story, officer, and I'm sticking to it, as they say. I don't know. What's your take, William?
Well, I just, everything is so changed this time. It's just like never has the Fed fought inflation after it's happened. It's always been, they've anticipated it. They knew it was coming because the economy was heating up, and then they would start raising interest rates. Now they're doing it after the fact, and this has never been done.
Yep. Yeah. They could overcorrect. They could overdo it. That's for sure. Yeah.
Or they could underdo it and inflation will continue on, which is kind of like one of the worst things for income investors, really.
Well,
So I would.
You remember the Volcker era when inflation was spiraling?
Exactly. So in the 70s, it was an after the fact fighting of inflation, and Volcker was brought in to raise interest rates and to fight inflation. That was after the fact. Now, one of the differences between that time and this time is the underlying causes of inflation, which in my mind are a combination of the pandemic and the side effects of the pandemic combined with the Ukraine war. And it seems to me that worldwide inflation isn't going to stabilize until those issues are resolved.
Yeah, most of the inflationary factors are really oil, I think. I mean, if they can figure out a way to get the Ukraine issue.
But the oil prices rose before Ukraine even came on the map.
Yeah,
that was the pandemic.
Yeah, that was a pandemic. Yeah, I think, I don't know. That's just my take on it. I don't know.
People were driving less during the pandemic, so I think it was the change in our our output in our own country of the oil getting shut off on so many. When Biden came in and just cut off the oil supply, basically.
Well, what's the effect of just what seems to me the creation of money, where we've given huge amounts of money to, well, the major tax cuts have simply increased the amount of money out there that people have, which is going to drive down the value of money. And so,
right. So that's inflationary, John. I mean, that's got to be huge inflationary factor. Yeah. I mean, but what was the other choice? I mean, there was really no other choice.
I wasn't saying whether it was right or wrong. You were discussing what are the factors.
Yeah.
That's a big factor.
Yeah, it is.
Yeah.
So that was a period of quantitative easing, and now we're going to be going into quantitative tightening, including the balance sheet being rolled back by the Fed. And it's going to be scary.
Yeah, I think you had an increase in the money supply at the same time that you had a decrease in goods supply, and the decrease in goods supply was a factor of the pandemic, whether it was factories shutting down or shipping snafus or whatever.
Yeah. I would keep my powder dry. I mean, I stuck with AT&T far too long. I should have dropped that stock, but I'll write it out now.
Well, that's the key question, I think, not the buying, but should we be selling even in this terrible situation? Because it's going to get even worse.
No, well,
I think there needs to be some trimming done so you do have more powder, but it always creates in a taxable account. It creates all these tax implications.
yeah. I don't know. My sense is that as long as they don't cut the dividend, I guess I'm okay. So I'm watching free cash flow and cash flow for my portfolio holdings very, very carefully to see if there's a potential for a dividend cut. If there is, then I'll probably bail out of the stock and take the hit from a capital gains point of view, if not at all. So being in a cash position going into a recession is, for an income investor, I think very attractive.
Yeah.
I think we're getting close to 3:30 here. Does anybody else want to comment before we kind of wrap things up here?
My battery's dying, so I've got to quit anyway. Thanks, Andy.
All right, John, thank you. Anybody else have any comments? Or Chuck, that was very good. I got to see that spreadsheet. That's very good. Impressive.
So did we answer the question that Tom posed? What should you do if you're not in a cash rich position right now?
Well, I have stocks that are overvalued. For example, I have Microsoft. It's a wonderful ride, but if you just look at the valuation on it right now, it's grossly overvalued. It's got to fall back to earth. There's just no way that it can continue to go higher and higher. So my take is I'll take some selling of Microsoft and a couple of other of my overvalued stocks. NEE is one of them that I've sold, I think, recently because it's overvalued, and then use that cash later on to buy some bargains, so to speak. Yeah, and that's right. I'll take capital gains on that. Grumble. But I don't see any other way around it. I don't know. Maybe you guys have some other ideas. By the way, the rough rule of thumb is you should never hold more than 20 stocks in your portfolio, because when you get out to 30 stocks, you're really the law of diminishing return kicks in, and so the thinking is that if you can hold it around 20, that's probably the best you're going to do.
I've always been confused with that one. Does that a mutual fund, of course, will hold hundreds of stocks? And
well,
if you've got a mutual fund, does that count as one hold for you because you're following one?
No, John. If you're holding a mutual fund or an ETF, then this rule doesn't apply. No, you can, because obviously you're diversified across that. Yeah. But if you're holding individual stocks, yeah, that's. Yeah. Any other comments before we wrap up?
Nope. Good discussion.
Good discussion. Okay. All right. Well, we're going to meet. Let's see here. Let me bring up my screen here. Oops. Don't forget our Google groups. That's there for your pleasure and for posting. I'll post everything that comes in. I may not be able to get the video for this up and running next week because I'll be out of town, but the following week I'll be back, and so it probably will be sometime that following week, be the week of May the 5th. That's all I have. Our next meeting will be June the 5th. You might want to submit some ideas and topics and suggestions, and if you're doing some work like say what Chuck was doing, by all means, please share it with us, because that's how we all learn, So unless I hear anything else, I'm going to stop sharing. Any other comments for anybody?
Thank you, Andy. Good session.
Okay.
Thanks.
See you guys.
Thanks, Andy.
All right. Bye-bye.
Bye.